everybody, it's John Llodra here for New Harbor Financial Group's weekly market update. Thank you for being with me. It is Wednesday, the 13th of December, 2023. Geez, can't believe we're just approaching Christmas and the holidays and almost the end of another year. What I'd like to cover today, I'd like to keep it pretty brief. Today is one of those infamous days. It was a so-called Federal Reserve rate decision day. Want to talk about that and some of the market reaction to that. And I'd also like to give an update of some recent trades and positionings that we've done in client accounts so we can give you a sense for what we're up to and what we're seeing. So without further ado, so again, today was the meeting of the Federal Reserve. It capped off a two-day meeting for their rate decision. Like many Fed days, today was an absolute eye-popper of a day. I'll get into some of the market action. But leading into today's meeting, over the last month and a half, the market had basically concluded, perhaps prematurely, but today's meeting was interesting, that the Fed was going to start not only stop raising rates, that they essentially have already peaked their rate increases this cycle, but that as we get into next year, they're likely to start to drop interest rates. Now, the market has consistently or many times gotten that forecast wrong. So going into today's meeting, a lot of people were walking on eggshells, so to speak, we included. We actually thought the Fed would be pushing back on the market and reasserting a higher for longer kind of message to the market. But what actually happened today is that the Fed actually came out and basically announced that they weren't going to raise rates. There was no surprise there. They stayed put at the current target rate of 5.25 to 5.5. So unchanged on those short-term rates. But they signaled that as we get into next year, that they would likely consider start to drop rates. And the consensus forecast in the Fed is for as many as 3 cuts next year, and a total of about 0.75 percentage points of rate drops. So that would bring the target rate at some point next year, per the Fed's kind of internal thinking, to about 4.6% from, again, the current range is 5.25 to 5.5, but the effective funds rate was more like 5.33%. So a bit of a surprise for us, and I think much of the market, that the Fed actually didn't push back the expectations of a rate drop. And, we'll get into some of the market reaction to that in a bit. But I first wanted to share some charts and kind of put this into context. So I'll show you what the market reaction to that was. So let me share a screen here. And what this shows is for different periods of time. So you can see that we can track it from essentially a month ago, November 13th of 2023, 1 week ago, yesterday, and today, what the market's expectations were for Fed rate policy. So the current rate level is 5.25 to 5.5. So basically what you can see, and this shows January of 2024 meeting, next month, basically the end of next month. So what you see here is that after today's meeting, there was a pretty sharp rise in an expectation by the market for the Fed to drop rates 0.25%. There's about a 16% market ascribed probability. Not a huge probability, but a big jump up from just yesterday, actually. If we go out to the March meeting projection, you see the market is now pricing in about a 67.4% probability that they'll drop 0.25 percentage point by the March meeting, and even a little bit of a possibility of a total of 50 basis points drop, a 0.5% drop between now and the March meeting. And as you get further out into next year, the May meeting, you can see the probabilities not only of a decrease, but a steeper decrease starts to take flight here. So what you see here is, by June, a pretty dramatic market expectation of a rate drop. Now, one thing I want to point out is, even as dovish as the Fed was today, the market is still kind of calling its bluff on the Fed. The market's still pricing in more rate drops than what the Fed has signaled. So, for example, the Fed has signaled that they'll drop to about 4.6% over the next year. So anything, basically the market by July is pricing in a full almost 65% chance that the rate will be below 4.6, somewhere 4 to 4.5, and even by next December, basically a high probability that the rate would be below 4.6. So essentially, the market is calling bluff on the Fed. We think this is setting up for possibly a shoving match between the Fed and the market, because of course, we still do think the Fed is deathly afraid about inflation starting to come back and things getting excessive. But this will be a wait and see thing. But again, count us as a bit surprised by the Fed's dovishness today. Wanted to kind of put into perspective a little bit, what history tells us about market behavior, at least over the short to intermediate term, when the Fed peaks rates and starts to decline. So I'm going to share a couple of charts here. Basically goes back to the 1954 for the current through the current date. And what this shows is the orange line is the federal funds effective rate, federal funds rate. Again, we're at about 5.33 right now, as shown over here. Back in the early 80s, this was as high as over 20% during the whipping of the severe inflation of the 70s into the early 80s. What the blue line shows is the pullback off of a peak prior high for the S&P 500. So in other words, this is the depth of declines. And what you'll notice here is most of the instances of big declines here, coincide pretty tightly with peaks in the federal funds rate. In other words, when the Fed stops hiking and then eventually starts to drop rates, that's usually coincident with a pretty steep sell-off of the market. Again, 30% here, over almost 50% here. Our simple admonishment is that the market might be careful for what it wishes for, because if history's any guide, the pivot of rate policy may ultimately lead to a decline in markets. And this zooms in on some of the more recent cycles. So this is the tech bubble of the turn of the century. Here's the housing bubble. Here's where we are right now. This is the COVID peak and then sell off. And what you see is the blue line is the federal funds rate policy lower limit, and these little dots, the red ones are actually instances where the Fed raised rates. The green ones are instances where the Fed dropped rates. And you can see in both the tech bubble sell-off and the housing market sell-off, the market sold off drastically, despite the fact that the Fed was dropping rates. And that's typically because the Fed drops rates like that, at least in the last couple cycles, in a panicked move, not a thoughtful kind of measured move. So jury is out as to whether past this prologue, but we think there's a pretty good case that if and when the Fed does start to truly pivot and drop rates, that it's probably going to be in response to a sell-off in the markets. Okay, and we'll be prepared, and we'll be obviously observing the day of the market. So let's pivot a little bit. Excuse the pun there, because that's on everybody's mind with the Fed, pivot timing. And let's talk about the market reaction. To put it bluntly, the markets were exuberant about the Fed's messaging today. Pretty much everything rallied: stocks, bonds, precious metals, a massive move. And I'll just show you a minute-by-minute chart here to show you the sharpness of the reaction. So this is a chart, a minute-by-minute chart of the S&P 500, SPX. Here's the Fed decision. You can see right out of the gates, we got rocketed higher here. I'm going to hide my own picture. Rocketed higher, had a little pullback, but then closed strongly. This is the day right here. This black area here is the day today. Let's look at what happened to bonds. Here's a chart of TLT, longer-term Treasury bonds. You can see the same thing. Very sharp reaction, very strong through the close, and actually rallying a bit after hours. This gray area is the after hours. Let's look at gold. Same thing, massive move in gold. Gold, the bullion was up over 2% today. Very strong and strong follow through in the after hours. Gold mining stocks, as measured by this ticker GDX, massive move higher, over 6% higher on the day after the Fed decision. So tremendous move and reaction by the market to what's going on there. So let's talk a little bit about our kind of recent reactions to what we're seeing in the markets and how we're repositioning client portfolios. So one of the things that we have been observing is, and we've said, both myself and Mike Preston in our weekly videos have been consistently mentioning the very overvalued stock market conditions. We remain very, very overvalued by historic measures. But increasingly, our shorter term indicators have been pointing to bullishness and the likely for follow through, despite how much we disdain the level of valuations. The actual market action has been suggesting to us that things could follow through further to the upside. So we'd like to position client accounts to take advantage of that without taking undue risk. And one of the things that is one of the many indicators we look at is the volatility measures, as the VIX is the measure. And that's been at really multi-year lows, putting in new lows by the day here. And it really speaks to a complacency. And I'll share a chart to show what that looks like. So this is the chart of the VIX, and this is the volatility index. You can see massive sell-off or decline in the VIX from the low 20s back in October to right now we closed down around 11 and 12. Massive pullback in VIX and volatility. We zoom out to a weekly chart, you can see we haven't seen those levels for a number of years. And in fact, if you go out to a monthly chart, last time we saw these levels was in 19 and early 20 before the COVID sell-off. So a tremendous amount of complacency here. And a couple of things that opens up for us. First of all, when the volatility index is as low as it is, the cost of hedging becomes much cheaper because, and we use options very consistently or often to hedge positions. And one of the key inputs to the pricing models that define the price of options is the market volatility. So when volatility is lower, the price of options and the hedging is much cheaper. So we've made a couple of portfolio moves in recognition of this. So first of all, we have had some what we call out of the money tail risk hedges in the form of puts on the S&P 500. We use this opportunity to extend those hedges out from January of next year to March of next year, because we do think we may likely see all-time highs, new all-time highs in the S&P 500, for example, over the next couple, 2-3 months perhaps, but then a pretty sharp sell-off after that. That's our kind of base case scenario. So we want to have this tail risk hedge. So we have these puts that are about will kick in after about a 10% decline, a little over 10% decline in the market. So because the cost of these puts is so cheap right now, we were able to extend them out to March without paying much at all for those. So that we felt that was a prudent move. We also, because we've seen the market registering a lot of bullish short-term signals, we actually used the opportunity to add a tactical long position of about 10% to the equal weight S&P 500. We added that yesterday, so we were able to capture so far good bit of that move today higher in the stock market by adding that equity exposure. And we did that by buying call options, slightly in the money call options on the equal weight S&P 500. And essentially, when you buy a call option like that, it's the equivalent of buying the stock, buying the index, and simultaneously buying a put option. So it's a way for us to have some increased stock exposure, but have that embedded put option protection to the downside should this rally not follow through like we expect it will. So it's a in our minds it was a very prudent move without taking a lot of risk. And again, we added about 10% notional long exposure to the equal weight S&P 500. Now, a note on that, we have seen a broadening of the participation in the market, an improving of breadth, as we call it. And in fact, whereas much of this year, the upside action has been in the very heavy capitalization weighted indices like the S&P 500 normal index, and that's dramatically influenced by very large cap tech stocks like the Mag 7s that we've been talking about, which are very overvalued. But it's been a healthy development to see the broadening of the market such that the equal weight has actually started to outperform. So today, the equal weight, for example, was up more than the cap weighted index. So that's a notable development that speaks to a broadening and follow through. We also did use this chance to put some collar hedges on our long-term bond position, long duration bond position, I should say. So we still have good upside potential there, but we have added some put option protection should we get a breather here in the bonds. And I'll show you what that looks like. So let me pull up a chart of TLT, which is an ETF that holds bonds, the longer term treasury bonds that we own for many clients. And I'll show you what that looks like in terms of our hedge. So we had a massive sell-off in bonds over the last couple of years. Bottom so far at the end of October, and we've had a very sharp rally of these bonds since then. What we essentially did is we sold call options that have upside potential of about 102.5. So very, very good additional upside potential here. But we're able to, and I'll zoom into the daily chart again here. We're able to put a line in the sand right here at 87 out through March. So basically, if we do retest these lows, which is a possibility, not our base case forecast, we do think there's going to be further follow through here and then probably a consolidation right around the low 100s. But we do have this downside protection should we see a retest of these lows. So very happy to been able to take advantage of some of the low VIX and the rise in bonds to do that. We did also add a modest position, about a 7% position to many of our client accounts, a bullish dollar position. The dollar has pulled back pretty dramatically, and we think that the sell-off in the dollar's gotten a little bit overdone, and we think there very likely could be a bounce in the dollar here in the near to intermediate term. So I'll just show you a chart of the dollar and give you a sense for what we're looking at. So this is a 3-year chart of the dollar. As you can see, the dollar index peaked at about 114 back, last fall, and has sold off pretty dramatically. It did rise pretty rapidly from about July 2023 of this year to October, and it sold off pretty hard here. We would not be surprised to see it kind of retest somewhere in the 110 area to the maybe as high as and challenge this prior high. So we wanted to put a tactical long dollar position in through an ETF that holds mostly treasury bills, but it has currency swaps exposure to have additional upside if the dollar rallies. And we do think there's quite a bit of support here in the 100 area, so we don't think there's much downside. This will be helpful for essentially a indirect hedge for our emerging markets, equity and bond exposure, as well as our precious metal exposure. Should the dollar strengthen, that might serve as short-term headwinds to those holdings. So this will be kind of a parallel hedge to that. So that's about what I wanted to cover this week. Obviously, we're here to answer questions that you might have about your accounts and not only your investments, but the basically bigger picture financial planning discussions that are relevant for you and your family. We've got a couple more weeks of the year. We'll continue doing these weekly updates. And until then, I want to thank you for watching and wish you a wonderful day and happy holidays. And we'll talk soon. Bye now.